The worst thing that can happen to a new participant is not losing their first trade. The worst thing that can happen is winning it easily and without friction. Winning creates an illusion of competence in an environment governed by pure chaos. I have seen traders double their accounts in a week, only to lose it all in a single hour because they thought they tamed the beast. When you win your first few trades, a dangerous chemical reaction occurs in your nervous system. Your brain floods with dopamine, reinforcing the exact behaviors that will eventually destroy your account. You begin to believe that you have solved a complex puzzle. You mistake temporary alignment with a statistical edge, confusing luck with genuine skill. You think you are trading the market, but you are not. In reality, the market is actively training you. Markets survive on participation. No participation means no liquidity, and no liquidity means no market. The auction mechanism naturally provides intermittent rewards to keep you at the table. It lets you draw a trend line and rewards you when price respects it, building your confidence meticulously. But you must remember that confidence is leverage in disguise. A hesitant trader risks a fraction of their capital, but an overconfident trader risks the entire account. An auction does not distinguish between a fraction and the whole. It simply absorbs all exposed risk. You spend hours optimizing your indicators, searching for the perfect crossover or the ultimate oversold signal. You desperately believe that a green light on a screen guarantees a profitable outcome. But those indicators are built on lagging data, showing you the past while the algorithm dictates the future. The machine knows exactly which moving averages the retail masses are watching. It knows where the popular indicators trigger a buying frenzy. It uses those exact mathematical signals as a dinner bell to serve you up as liquidity. For massive institutional orders to be filled without slippage, a strong consensus must be reached right before the reversal. This is the concept of inducement, the structural reality of how liquidity is engineered. It is not a malicious conspiracy, it is simply supply-seeking demand. Consider the classic breakout scenario that every retail trader is taught to trade. Price approaches a major resistance level and stalls, building tension over hours or days. Retail participants watch closely, anticipating the break with their fingers on the trigger. And this is where most traders lose everything. Suddenly, price pushes violently through the resistance, and momentum indicators flash a blinding green. Breakout traders aggressively execute market buy orders as the fear of missing out drags latecomers into the trade. The trade immediately goes into profit, making you feel validated. You move your stop loss up to secure those profits, placing it just below the obvious breakout level. You have just handed the algorithm a precise roadmap of your exit liquidity. The smart money desk that facilitated that initial breakout now has a massive pool of buy orders to sell into. Your excitement is simply their execution phase. Once the retail buying pressure is fully absorbed, the market makers stop supporting the price. They pull their bids from the order book and the price stalls heavily. Then it drops back below the breakout level with terrifying speed. This is the fake-out, the engineered liquidity sweep designed to clear the board. Your stop loss is triggered, instantly turning into a market sell order. Thousands of other retail stop losses are triggered simultaneously in a violent chain reaction. This sudden cascade of selling pushes the price even lower, accelerating the panic. Once the trap snaps shut and your stop is hit, a new psychological phase begins. The initial loss was just the entry fee for the real extraction. Your ego demands immediate revenge to erase the humiliation of being wrong. You re-enter the market immediately, abandoning all logical protocols and risk management rules. You increase your position size, convinced that the market owes you a refund. This is exactly when the algorithm strikes for the second time, completely emptying your account. The institution that sold to you at the top is now buying back their position at the bottom. They use your forced capitulation, your revenge trading, as the exact liquidity they need to accumulate size. The pattern you saw on the chart was never a setup designed for your benefit. It was a carefully constructed setup designed specifically for them. You are left confused and angry, blaming manipulation or a rigged system. But you were simply a predictable data point in a highly optimized transaction sequence. The chart does not offer certainty, it merely displays executed orders, and heavy volume always attracts more volume. A clean, perfectly obvious pattern is rarely a gift to the retail trader. If a support level has been tested 5 times and looks incredibly strong, it is not a fortress. It is a target. It is a massive pool of stop losses waiting to be harvested. The more obvious the setup appears to the public, the more dangerous the execution becomes. This is exactly why true operators do not trade textbook patterns. Operators trade the structural failure of those patterns. They understand that true, actionable liquidity resides precisely where the retail trader places their stop loss. Your stop loss is someone else's entry, and your panic is their profit. They wait patiently for the trap to spring, refusing to participate in the initial rush. While the retail trader aggressively buys the breakout, the operator waits for that breakout to fail. He waits for price to sweep the highs, trap the eager buyers, and then shift structure. The retail trader views time as an enemy, feeling the constant burning pressure to be in a trade. The operator views time as a weapon, sitting in cash while the machine slaughters the impatient. Cash is not a lack of position, it is a highly tactical stance. The operator enters the market only when the retail trader is forced to exit in panic. To survive this environment, you must actively unlearn your previous conditioning. You must completely stop seeking validation from temporary luck-based profits. Where is the obvious support that every retail trader is currently watching? Where is the perfectly clean trend line that looks too good to be true? Once you identify the consensus narrative, you must locate the trapped liquidity. You must become comfortable with the deeply uncomfortable realities of price delivery. The highest probability entries often look absolutely terrifying to the untrained emotional eye. They occur after the sweep, after the panic, when the chart looks fundamentally broken. When the chart is bleeding and panic is peaking, the amateur freezes. Their nervous system cannot handle the visual threat of a crashing red candle. But the operator reads that exact same candle as a simple transfer of wealth. Look for the moments when price violently breaks a level, takes the liquidity, and immediately rejects back. That rapid rejection is the undeniable footprint of smart money stepping in. That is institutional absorption, and that is the exact moment the operator strikes. Even a system that wins 80% of the time will blow up your account if you cannot manage risk. If your winners are small out of fear and your losers are massive out of hope, the math is inverted. The machine guarantees your eventual bankruptcy. This profound shift in perspective requires immense, unwavering psychological discipline. The market acts as a flawless mirror reflecting your own psychological flaws. It ruthlessly exposes your impatience, your greed, your underlying fear, and your arrogance. Assume every pristine formation is a trap until proven otherwise by structural confirmation and volume. Operators do not trade to feel intelligent, nor do they trade for excitement or adrenaline. They trade solely to execute a mathematical edge over a statistically significant sample size. The market does not reward intelligence, it rewards discipline. In this arena, you are either the architect of the trap or you are the liquidity within it. There is absolutely no middle ground for the uninformed participant. Silence the overwhelming noise of the obvious. Protect your capital from the emotional sweeps. Anticipate the inducement. Wait for the structural failure and execute the protocol without hesitation. The structural logic of the machine is always learning and adapting. The only remaining question is, are you doing the same? If this perspective changed how you see the market, comment the word operator to initialize your next phase. Execute.